Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. I'm Paul Winkler, talking world of money and investing. You know, the idea is to get to the point where you do what you want to do and have money work for you. You know, maybe go visit grandkids, go travel the world, and maybe that's not the most practical thing right now. Well, I guess maybe it still is to some extent, but, you know, things come and go, don't they? You ever notice that in life? It's like it moves in cycles. Yeah, things are great, then they're not so great, then they're great, and then they're not so great, and then you just go, well, okay, you're just not going to figure this out. Life is an up and down thing. But, you know, the idea is to plan for that day when things are up and you can do the things that you want to do, and maybe that's just traveling around the U.S. Maybe it's seeing things you never saw in this country. Maybe it's going abroad. Maybe it's going and hanging out with family members in other places, or just being able to go out to eat and do the things you like to do right in your neighborhood. Maybe you're a homebody. You don't like to do any of that stuff. So, but this is the show for that, and just helping you understand more about investing so that you're not blindly trusting investment advisors and not blindly trusting mutual fund companies, because let's face it, mutual fund companies are marketing to you. And they may not necessarily be telling you the right stuff either. So, you know, you got to be really, really wary. And that's what I like to do here on the show, is educate, because the more you understand this stuff, the less you worry about it, but the more difficult it is to actually lead you astray. And one of the ways you can do that is to ask a question by going to paulwinkler.com/question. That's one way that you can do this. And what happens when you ask that question is we get an email that you have a question, and then we have your email address. We can email you back when I have an answer, or when I've done an answer to the question on the show. You know, so we do it in a segment, and then we'll send it to you. So, you know, because the podcast is on the website, paulwinkler.com, and if you're subscribed to it, you may actually hear it, but if you're not subscribed to it, shame on you. No, but seriously, you actually can get an email from us. So anyway, we want to make sure that you get the questions answered. And again, it's paulwinkler.com/question. Okay, so Roy asked the question for the show, so I thought I would start off with that. He says, you suggest 8 categories of investments. I said large, small cap, value, growth, U.S. and international. So yeah, in general, when we talk about the market, the market is just too broad of a term. It drives me crazy. What did the market do today? Well, which market? You know, if we look at some areas of the market, you know, even though you have areas that are down quite a bit, there are other areas that are up quite a bit year to date. So it's just, most people don't realize that, because all they hear is the term the market, which is typically just referring to big U.S. companies. So you got small companies, you got large companies, you got value companies here in the U.S., value companies, and you got growth companies, and so on and so forth. So, you know, it says, I've always had good returns with midcap, he says. And what is the reason you're not recommending them? Well, the reason comes down to academic, because that's where I always focus, is what do the academics say? What does the academic research say? And, you know, when you put together a portfolio, I'm not just looking at returns. You know, it may sound blasphemous to say I'm not just looking at returns. I'm also focused on risk-adjusted returns. So risk is a part of the equation when it comes to investing. Now, I may have 2 portfolios with the same exact return, but I end up with really, really different outcomes because of the level of risk. Now, in the accumulation phase, risk is not that as big of a deal in the accumulation phase of investing. In the distribution phase, it's a big deal. You know, so but it can be kind of a big deal even during the accumulation phase, you know, so don't get me wrong about that. You know, you can have volatility that actually works for you, because if you're putting set dollar amounts away, you're buying more shares when the market's down and you're buying fewer shares when the market's up. Well, if you don't have that level of volatility, in a portfolio or in the asset classes in your portfolio, you're not getting that benefit of being able to buy more low than you do high. So, it can have an effect on the accumulation as well. But distribution is a huge area right there. So if we walk through it and go, okay, so what's the deal here? Well, there is something called the goalpost effect. And this is where you go back and look through history. And you go back to the 1920s, for example, and it's University of Chicago has what's called the CRSP database, CRSP. So it stands for Center for Research and Security Prices. And they gather data on everything, so there you can, and I love it because I have the actual data on my computer that I can go to and look at. And the way they break up the market in the CRSP database is based on tenths. So they look at New York Stock Exchange and the old American Stock Exchange and the NASDAQ, and they look at companies and say, okay, the top 10% of companies in the NYSE, New York Stock Exchange, that would be, and any like-sized companies on the other exchanges, that would be decile 1. And the next 10% largest companies, that'd be decile 2, and all the way down to decile 10 would be the smallest companies on those exchanges, right? So that is how they break the market up. Now, a lot of times they'll group things. They'll say, well, 9, 10, 20% smallest companies, that's going to be the microcap area. And then 1 and 2 is going to be the S&P 500 in general. It's about the same size as those companies. Now, these are cap weighted, so it has the same issues that I always talk about with indexes in that they overweight big companies. But, so we can offset that to some extent by looking more at the micro side when we're doing research. So if I'm looking at 9, 10, it's more micro, but it's the bigger micro companies that is going to dominate to some extent. If you don't know what I'm talking about, it doesn't really matter. It's not really that. I'm like, well, this is getting complicated. No, okay. So let's say we look at the market, and we say, okay, so decile 3, 4, 5, we'll call those mid caps. Okay, so if we look at that and say, well, what happens when we go back through history all the way to the 1920s and say, I want to just see, in any given year, and I'm just going to put a little box around, this is what they did, the area of the market that had the highest return in, let's say, 1927, and what had the lowest return in 1927. Did decile 1 have the highest return? Well, what had the lowest return? Was it decile 9? Okay, so if it is, then really big companies did better than small companies, or less bad. You could have both of them went down in value, but one went down 10% and the other one went down 30, okay? So that would be the most dissimilar price movement because every other return was between -10 and -30 in my example. So you get the point. What I'm doing is I'm looking for dissimilar price movement because what do we diversify for? That's why. We want dissimilar price movement because I want not all my eggs in one basket, but if both baskets are falling, that's a problem. I don't have any place I can pull income from, or if I'm putting money in and everything's moving together, I don't have something that's gone down more than the other thing. If I have two things and one went down more than the other, well, when I'm putting money in, I'm going to be putting more money in the one that's down further. So if you think about it, what am I doing? I'm buying more low. So it's even important in the accumulation phase, if you see what I'm saying. Okay, so we look at this and we say, okay, so when I go back through history and I say, well, what had the best return in 1928? Well, let's say that it was decile 9. And then decile 1 or decile 2 had bad returns or not as good of returns. Well, then we got a year where we've got the other thing happening. So if we look back through history, we notice that the most dissimilar price movement occurs with really big companies and really small companies. And we go, if diversification is owning things that don't move with each other, maybe then having more dissimilar price movement is a big deal, right? Maybe having that type of movement where things aren't going together is better if diversification is good, right? And we can logically think about, well, why would diversification be good? Yeah, it makes perfect sense when we think through the ramifications of risk, whether it be in the accumulation phase or whether it be in the distribution phase, okay? So now we look back and we go, okay, let's just step back and look at this chart now that we've highlighted the highest and lowest returning areas. And what we notice is that the highest and lowest returns tend to occur at the periphery, which makes sense. I mean, you think about it, big companies and small companies would have less in common with each other than big companies in midcap, because they're both fairly big when it comes to medium-sized companies. Would make sense that maybe some of these same economic factors are affecting them, right? So that's what we're seeing when we go through history. And when we line things up, decile 1 all the way on the left and decile 10 all the way on the right, and we've highlighted this stuff, we start to see this pattern that at the edges is where the activity is occurring. So it looks like a goalpost, okay? So hence the reason the goalpost effect. Well, what happens is that we go, okay, so what implication does that have? Well, lower volatility because I have that dissimilar price movement. Well, okay, so what? So let's say that you took a portfolio, and just for the fun of it, what I did is I just ran some numbers for the show using the database just to make the point. And what I did was I looked back and I said, okay, so let's say that in 1926, that we had $100,000, okay? And we just took out $5,000 every year, $5,000 out every year, and we were living off of that money. And I had one portfolio that was a mixture, and this isn't scientific at all, I didn't really get into value, growth, or any of that stuff. I just used large and small, okay, just to keep it really, really simple. So I'd used S&P 500 and CRSP 910 and had half my money in each. And what if I did that versus what if I put my money in midcap? Now, what happens is this, is that, I go from 1926 till now, and I literally had about 8 to almost 9 times as much money left in the portfolio that was divided between large and small versus the one that was medium size, okay? Huge difference in the amount of accumulation left, okay? So you go, whoa, wait a minute, what is going on here? Well, part of it is the fact that if you think about it, if I'm rebalancing, if I have a portfolio and I'm rebalancing and one does really well and I've got more dissimilar price movement, that rebalance is more effective. Because if I got one that takes off and the other one's kind of, not doing much of anything, what am I going to do? Is I'm going to go, oh, it's supposed to be 50% large and 50% small, and now it's 60% large because large had a good year, and 40% small because small had a bad year. Okay, I think we ought to go and sell some large and buy some small. Bring it back to 50-50, okay? So with that, that's one of the effects that you have, and that's, buying more low, selling high, and managing the portfolio in that manner. And by the way, when I was doing this in the data, I was just rebalancing monthly is the way what I was using in the research. So if I look at that and go, wow, okay, so that's a big difference. Now, why is it that so many fund companies were talking about mid-caps? Why were the mutual fund? Well, mutual fund companies are trying to sell stuff to you. I mean, that's their job, is to sell things. That's why they exist, right? So if I look at, what happens and, what happened during the period of time, this is something I did a show on where I was talking about medium-sized companies and, how I was seeing this stuff in the advertising. And medium-sized companies had higher return. And, if you look from 2000 to 2015, it was, the return of medium-sized companies was higher than our portfolio of large and small. So it was higher. And you look at it and go, why do I want to do that? Matter of fact, one of my guys, Jim was telling me that a client had actually asked that. He says, my portfolio, that you guys are watching over has it's kind of it's mid-cap, right? Well, no, it owns large and small. Well, on average, though, it's mid-cap, right? Why don't I just own mid-cap? Because of what I'm talking about here. It's a big thing to keep in mind that you separate these things, because big companies are going to be very different from small companies for lots of reasons. Economies of scale versus the ability to change on the dime when it comes to technological changes, to implement new technology and things like that. So if we look at midcaps, though, from 2000 to 2015, we're going, yeah, why? Why do you bother to do that? Just own a midcap portfolio. And the mutual fund companies started coming out with ads and going, hey, we got this midcap fund and this is the return on it. And people go, hey, wow, well, that's really, really great. What if you, over that same period of time, from 2000 to 2015, what if you took an income from the midcap portfolio versus large and small? What happened? Well, it was a close call because of the higher returns for midcaps. But the small and large portfolio actually ended up at a higher value. So if you put $100,000 in and you took out $5,000 per year, you have about $126,000 left, or $128,000 left, at the end of 2015, in my example, versus $126,000 in the midcap portfolio. So again, it wasn't a big difference, but you see that the difference did run in favor of the portfolio that was mixed between the two. Now, if you go to 2021, and if you did that, and you go, well, what was the difference from 2000 through 2021? Well, now you're looking at a difference of somewhere in the neighborhood of about $40,000. It's a much bigger difference over that period of time. So what does that tell you? Well, the mutual fund companies were selling people on medium-sized companies, and it really wasn't a good idea to have followed that advice, because just over a short 5-year, 6-year period, the whole thing changed. To be a much, much larger difference between the two, you see? So, because technically we were starting out about the same dollar amount, right? Between the two in 2015, the end of 2015, we were only a couple $1,000s different from each other, but we ended up $40,000 different. So you go, whoa, that's a big deal, okay? Now, what is happening here is, I think you can kind of see, from the difference between the two of them, that what happened was that risk is something that you have to consider in the investing process. You can't just throw that out and forget about it. But so often the mutual fund industry, all they do, they have a tendency to just market based on what is easy to compare. Now, for the average general public, the easiest thing to compare is the return of one thing versus another. And they don't even think about the impact of risk on the investing. People say that, well, risk is important. And this is one of the 20 questions I always ask people, when they first become clients, hey, do you understand how to measure risk in the investing process? Tell me, how do you measure it? And they sit there and go, I don't know. Well, is it important to you? Yes, it is tremendously important that I control risk. Well, how do you control something that you can't measure? And that is where the rubber meets the road. So I think it's super, super important. So why midcaps? Why not midcaps? That's it. Really gets down to it. It was just a marketing thing by the investment industry. Some of the... It was funny because there was one fund company that was actually trying to make the point that, you can save trading costs by not selling small companies when they become medium-sized companies. And I just shook my head and going, good grief, you guys are just missing the boat. You're, again, trying to market to people. And to me, the marketing just gets in the way of good decision-making. And if you can get to understanding more about investing, the marketing doesn't affect you as much. So really appreciate that question. Great question. Really, that was fun to answer that, Roy. So thanks. And if you got a question, paulwinkler.com/question. It doesn't have to be that complicated. It can be something fairly simple that you want to run by me. But by all means, you'll see that I like to answer these questions.